Good morning, Emily.
Good morning, Dan. You look stressed.
No, I was born tired and gray haired. So, what are we talking about today?
What's going on in the markets? When and why someone should let a financial planner manage their accounts, and how best to invest when you have a short term goal.
Welcome to the Science of Wealth, where we discuss the science behind financial planning and the art of learning and applying it. Okay, so we're going to talk about my tired gray hair status. Lovely. Okay, what is the question here? Surely you've been watching the news.
Surely everyone has been, which is why I'm also getting a million questions a day from everyone I know. What is going on in the markets? Why is everything suddenly plummeting? What's happening?
So, the current events basic answer for this that everybody is going to be aware of who's listening to this is the United States has placed tariffs on essentially every single other country in the world except for a couple of very suspicious omissions. But in that process, the tariffs are enormous. Most tariffs are measured in like a couple of a percent, 5%, 6%, 7%. Our minimum tariff we've put in place is essentially 10%. Some places are getting, 30, 40, 50. I think China now, as of today or yesterday, is at like 104%. So we're essentially suddenly, adding 20, 30, 50, 104% to the cost of goods from all these various countries. And that has a rippling effect, obviously. Like if you were buying a bunch of steel from a country and it used to cost $100 a unit and now it suddenly costs $140 a unit, that kind of screws up your entire business plan and business model and has huge rippling effects that kind of go through everything. So that's the basic answer of the current event and what's really causing some issues in the market.
Well, I'm going to ask you some of the questions that I'm receiving, so you have the chance to answer them. But, isn't this a good thing, is what people are saying? Then we'll just start buying American made products and really support our own home country and businesses.
I saw a really interesting example of this the other day that somebody used, and I'll apologize if the veracity of this is not as strong as it could be, so take it with a grain of salt. But the example is talking about how at one point we put tariffs on appliances like washing machines, and the tariffs essentially drove the price of foreign produced washing machines up by like $200. And then we did away with the tariffs on the washing machine. So then presumably that should have dropped the price, but the price only came down like $75, $80. Because one of the things that happens is that everybody who gets involved in the tariff game, right, whether you're a domestic producer or a foreign producer, raises their prices accordingly. One of the things that happens with tariffs is that if foreign producers have to increase their price by, let's say, 20 or 30% to cover the taxes, domestic producers can also increase their price, right? They don't have to increase it the same amount, but they can increase it, 10, 15%, because you've created this sort of de facto, like, national boundaries monopoly where essentially like, oh, they can buy from quote unquote the other guys for 20, 30, 40% more, or they can buy from me for 10 or 15% more. So it often increases costs all around. The interesting case here is that there's sort of an interesting push-pull between like inflationary factors here, which is the cost of a lot of stuff you're going to buy is going to go up. The example that I'm thinking of right now is like the Nintendo Switch was about to go on pre-sale for like $400 a unit, and now, or so like the Switch 2, and now it's supposed to be like $650 or $700 because guess where they're made. So in that context, you're really going to see suddenly this huge increase in the cost of certain consumer goods, everyday things, right, from cups and plates and bowls to appliances to TVs to cars, and nobody gave the American public a bunch of extra money to cover these costs. So you can argue that this is good for like domestic or like international relations in the standpoint of like, we've been getting a raw deal. That's a whole separate argument people could have, but that is probably the best argument you could make. But it's not really good for domestic producers necessarily, because a lot of domestic businesses rely on foreign exports or imports to fund their business or provide the goods and materials that they provide.
Okay, so is this the new norm, or is this just like maybe a short term thing and people are kind of hoping they change their minds or they reverse these decisions? I'm hearing a lot about that.
This is where you get sort of the talking out of both sides of your mouth thing, because the argument for the tariffs, like the official government line, is that our trade agreements are so terrible that it constitutes a national emergency. So the president is putting tariffs in place, because normally the president does not really have power over tariffs. That's a Congress thing. But the argument here is like it's such a big deal that it's a national emergency. So we got to put these tariffs in place because we're just getting absolutely destroyed on economics, which is hilarious since we're the wealthiest country in the world. But the other side to this then is what's obviously clearly being done in practice is that the presidency is now using these tariffs as a negotiating point to force other countries to negotiate with us. And so, like, to one extent, you have the official thing, like, it's obviously a big emergency, it's very serious, but then in practice, we're obviously just using it as a negotiation chip.
Hmm. So for the time being, things are just going to be expensive and there's nothing we can do about it. That's what we're saying here.
Nothing we can do about it insofar as like macroeconomic policy is beyond any of our ability to really influence unless we're literally the people making the macroeconomic policy. I think there's some obvious budgetary conversations here. If you were going to buy a car that's normally produced in Japan and suddenly now that car costs 30% more or 40% more, you're obviously in a position to say like, well, maybe not that car, right? To start looking for alternatives or start being a little bit more conscientious about your purchases, about your consumption behaviors. I don't think these tariffs are going to be a long lasting thing. And I want to be really careful in that because, people who make economic forecasting commentary tend to be really terrible with this. I don't see it lasting a long time because a lot of businesses will fail under this situation, right? There's sort of an issue where the market can only bear so much change, and this is where we talk about elastic and inelastic goods, right? Like a water is an elastic good; you need it to survive, therefore you will functionally pay any price for it at a certain point. Whereas other goods, people will just skip on, right? If it's too expensive, they'll just say that's a luxury good. I can't afford it. I'm not doing that. And certain businesses, particularly those with inelastic prices, are going to run into some pretty serious problems the longer this goes on. So to that extent, there's sort of the golden rule of politics: don't break the economy. Doesn't matter if you are Mother Teresa and did the literal, Son of God return to life. If you break the economy, people will not vote for you. So there's a political reality here, which is you can play this game for a little while, but the longer it goes on, the more damage it does, the more people lose their jobs, the more businesses that close down, the more products that become unaffordable because of how high the tariffs are, and so on. The more likely that you're going to see a counter pressure build to undo this or push the back on this or get this kind of undone. So I think at the end of this, we'll see obviously a different balance of tariffs between the United States and these various other countries. There's sort of an off ramp option, which I like, which is just zero tariffs. How about we all just agree that tariffs are an antiquated idea and we should all just stop doing tariffs? I don't think we're going to get there, but there's certainly some off ramps where suddenly all the pain goes away. Because the trick here is that yes, the foreign entity pays the tax in the literal sense, but then the prices increase domestically to cover the tax. So all of this is just pulling money out of our pockets at the end of the day.
Sure. Well, what an exciting, uplifting way to start our podcast, but it is all good information that we've been getting a lot of questions on.
Well, and in the meantime here, again, if you're in your 40s or 50s and you're saving for retirement or you're trying to build up capital, great. Like everything's on sale for a while. Everything's on sale, 5-10% at the moment. And that's terrific, right? I get to buy stocks for the same price that they were selling for a year ago. So now I haven't lost out on the time value there. I get to double down on the time value for a temporary period of time. Obviously, this is a little bit more concerning if you are a retiree living on a fixed income. This is where I think having a cash runway in retirement, access to a reverse mortgage or a home equity collateralized mortgage is really helpful. But obviously, everybody's going to be in a slightly different position and have a slightly different set of concerns. I think the biggest thing that comes out of a situation like this, though, is that this is where people are potentially going to demonstrate that they are hardier than others. And some people are going to make the classic mistake. This is where we come up with that Warren Buffett, right? Be greedy when others are fearful, be fearful when others are greedy. There's a lot of people who are being fearful right now. If they weren't, the market wouldn't have tanked so much over the last couple of days. But on the other side of that, right, there's people who are taking advantage of the opportunity. I'm taking advantage of the opportunity. We had a couple of clients dump a couple $100,000 into their accounts over the last few days just to buy in because everything's on sale. That's the best place to be in. If you don't have the cash to do it, that's fine. Such is life. But at the end of the day, right, the market and the economy are not synonyms. They just affect each other. So just keep in mind that, just because the economy is going one way and the market's going one way doesn't mean that you're going to lose your job necessarily, something like that. But conversely, unless you're really, really tight on your finances and really don't have a lot of wiggle room, what's going on right now is just the latest iteration of a thing that happens all the time.
Sure. So maybe viewing it as an opportunity, if that applies to you, would help soothe your stress a little bit if you have some extra cash to contribute and things like that.
Yeah, and at the end of the day, investing in the markets and so on is always this act of faith, right? I'll be better off if I do this now instead of just consuming the money now or enjoying the money now. And in that particular regard, what I'll say is I've met a lot of people who were upset that they sold out during .com in 2008. People who were investing back in Black Monday who got out. I've met a lot of people who are like, I'd have a lot more, but I panicked. What I haven't met is anybody who's ever complained that they just stayed invested through 2008 or 2001, 2002, or any of those types of events. Same thing with COVID, right? We literally, you and Emily, you know who I'm thinking of when I say this, right? We have a client today who in part hired us because they got out during COVID and have not been brave enough to get back in, and have finally hired us to help them get back in and be invested. And I wish the timing was a little bit better for that, but like that's part of the game in economics and investing is it's a multi-year, multi-decade thing. And if you make your decisions based on what's happening today, you are almost always making a mistake.
Sure. That's, I think, why we tell a lot of people a big part of what we do is just coaching. Like, sure, people need help with the technical aspects of finance, but also the emotional pieces and parts of what do I do when I'm nervous or when I'm panicking.
I have to say, it's almost like a bad comedy sketch or something, because it's almost embarrassing to say how important that is, like as a thing that we do. Like I have a PhD in personal financial planning. I've been doing this for a decade. I'm a CFP, CHFC, AIF. I've read a million books, all of this stuff. Like I've studied this stuff to an embarrassing degree, right? To an unnecessary degree. And still to this day, the most valuable thing I ever do for my clients is get them to be invested and get them not to shoot themselves in the foot. Like it's embarrassing how many times clients or people come to us and be like, "Hey, should I shoot myself in the face?" Like, no, don't shoot yourself in the face. But like, I'm really concerned. Should I shoot myself in the face? No, do not shoot yourself in the face. Well, somebody was telling me that shooting myself in the face is a good idea. No, do not shoot yourself in the face. It like you think that would just be so obvious, and yet we have to spend so much time convincing people not to destroy their financial lives for no reason. It's incredible. I don't need a PhD to do it. I don't need a CFP to do it. Anybody can do it. Like that's the weird part of it. But at the end of the day, people just like need deep comfort and confidence that it is not a good idea to shoot themselves in the face. It's just a fascinating quirk of human behavior.
Well, I mean, it adds variety to our jobs. I'll say that. It gives us a break from the spreadsheets to have these human connection conversations, which I somewhat actually enjoy them. I like talking to people about it, even if it's the same repetitive conversation about not shooting themselves in the face. So I like the variety there.
Okay, new business plan. I'll do the spreadsheets. You talk to the people. It's going to be great. Hear that, everybody? Emily's going to talk to all of you. I'm just going to do math in the back room. We're all going to love our day.
You are so much faster on Excel that probably actually would make sense.
Yeah, it's a skill like anything else. Anybody can learn. Anybody can talk you out of shooting yourself in the face. Anybody can learn Excel.
Yeah, Excel is less interesting to learn, but you're right. All right. On that note, I'm going to pivot a little bit to one of my other questions, the way I always smoothly do in these episodes. I want to talk about whether or not people should let their financial planner manage their accounts, because it's not always a requirement. It is the most common way to go about it, but I want to talk a little bit about what the benefits of delegating are.
Yeah, I mean, there's just the very basic thing here, which is like any other form of delegation, you don't have to do it. Like that's the core value right there, is you don't have to do it. Now, sometimes you don't have to do a thing that you're perfectly qualified to do. Like we have clients who have worked in banks and in finance, who have degrees in this stuff, and they're like, yes, I could do it. I just don't want to. Like it doesn't entertain me anymore. I don't enjoy it anymore. So take it over for me. And conversely, there's people who I can tell them every little detail and try to educate them as much as possible about their investments. And they will look at me and be like, cool, I don't know what any of that meant, but it sounds like you do. So thanks. Take it over for me. I think the basic answer to your question, right? Why should you do it? Not because we're going to do any magic. It's just that we're going to do it right. right? Same thing as like hiring somebody to mow your lawn or to, build a set of steps on your house with concrete or whatever. Like you can probably figure it out or do it. But if you don't have the time, energy, enthusiasm, or ability to do it right, you're probably better off having somebody else do it for you. That's the basic answer to your question.
Sure. And there's some other details I think at certain times. Example, our advice being time sensitive. Some of the people that do choose to do it themselves and manage will come to us with questions and we'll say, okay, this is what you should do. And then 2 weeks later they do it, and it's like, well, that actually isn't good advice anymore. Things have changed in the meantime.
Well, and that's where sometimes we have a hard time sort of being taught or training ourselves to have longer term time horizons, right? Like there's literally a book called Thinking in Bets. There's all sorts of human psychology about how essentially everything we do is just sort of like this instinctual risk return trade off decision. And a lot of people have a hard time with like, I did the thing and then it didn't work perfectly instantaneously and create benefits immediately. So now I'm worried that I made the wrong decision. But something like investing in the stock market or doing a estate plan for yourself, right, getting a will and trust and all that stuff in place, isn't about immediate gratification and return. It's about creating a better long-term future for yourself. And so obviously, if you invested money last Wednesday, you're probably pretty upset about it because holy crap, the markets just blew up in the last week. But on the other side, right, if you're investing money this Wednesday, you're probably like, hey, stuff's on sale. I'm glad I didn't invest a week ago. But the funny thing is over the run of 5, 10, 15, 20 years, it's not really going to matter whether you invested last Wednesday or this Wednesday.
I think that's a good thing to explain to people in this example, because I do hear a lot of people, one of their qualms about delegating their investment management to us is, what if you guys make moves or make changes and I don't know about it? Like, are you going to call me or email me every time you make a change? And what does that look like for you guys?
No, because that would be the sort of analogy equivalent to like the pilot on the plane or the driver of the bus, like going into the back and be like, all right, passengers, so like I need to adjust direction by 2 degrees. Can I adjust direction by 2 degrees? And like trying to get a consensus from the passengers about whether that's a good idea. Like it's just not practical. And even if everybody eventually agrees to do the thing, how much time has been squandered on that process? And that can be a little bit disconcerting, right? You're giving up control of something you had control of previously. That can obviously be a little uncomfortable. But I mean, you do the same thing every time you get onto a bus, sit down on a plane, have a surgery, right? Hire any professional to do anything for you. You are ceding control of that thing to that professional. You are trusting them to do the right thing for you, whether that's a quick 1 hour project or something over the course of years and decades.
Sure, which I think just highlights the importance of hiring a planner or advisor that you actually trust and like, which makes the whole process quite a bit simpler for you and a lot less stressful.
I think that's a really big part is personality alignment. Having a sense of comfort and confidence in them. You want to be careful about picking your planner or your advisor solely from personality factors because there's a lot of charming morons out there. But on the other side of that, to that extent, if you don't like them, if they don't communicate well with you, if they don't help you feel more at ease and more comfortable over time when things are rough or tough, then maybe they're not the right fit for you.
Sure. Are there ever instances where you'd recommend people not delegate to their planner, that you think it does make more sense for them to maintain that control?
So yes, but I want to be really careful about it because some people here are going to start like self-identifying in that. So I want to be really careful with that. I think it makes sense if you have the time, energy, enthusiasm, and knowledge to do it right. And that last part's probably the most important part of it. Like just having a really honest gut check and saying, okay, like what education have I received on investing? Like, did I study finance in college? Have I spent hours, days, weeks, months, years, like getting an understanding of the markets, et cetera? Because the trick is, there's this like old expression about, like this engineer retires and the next day, like the oil rig or factory, whatever he works on, suddenly stops working. And they call him back to fix it, and he's like, that'll be $3,000. And like, sure, we'll pay it. And he walks out and he just like hits something with a hammer, and suddenly it works again. And they're like, well, that's stupid. Like, we are not paying you $3,000 to hit something with a hammer. And so he gives them an invoice and says, hammer hit $1, knowing where to hit the hammer, $2,999. Like, that's the knowledge factor, right? Like, just investing in an index fund, allocating that way, whether you put money in pre-tax, Roth, et cetera, that's the hammer hit. that implementation part is easy. It's knowing what's right for you that takes a lot more time and energy and thoughtfulness and education to accomplish correctly. And so that's where the education piece comes in. And so if you have that education, great. And then it's just a matter of time, energy, and enthusiasm. Like, do you have the time to do it an appropriate amount? Do you enjoy doing it? Is it time well spent for you? Or is it sort of energy draining, right? We have some clients who've been very successful at sort of managing their own investments and building wealth over the years who eventually come out and say, like, you know what? I've been great at this for years and decades, and I think you're probably going to do probably more or less the same thing I'm going to do. But like, I'm sort of tired of watching it. I'm tired of getting stressed out about it. So it's interesting because kind of the higher somebody's wealth gets, the more likely they are to delegate it. There's always this DIY group of people who would never trust anybody to do anything for them. I'm not really talking about them, but for the wealthy, it's funny. We get more pushback from people about managing their investments when they have a small portfolio than when they have millions and millions of dollars. So it's just sort of this funny quirk of human nature is we often think that if we do it, we have better control over it. But and in some cases, it makes sense. Go ahead and self-manage. But in a lot of cases, you not only don't know what you're doing, it's just not a good use of your time.
Sure. Whatever's the most valuable use is what you should do, and delegating is always much easier and nicer, stress level wise.
I was just gonna make fun of my wife here for a second, and myself actually more than my wife. Uh, I'll say here, just for the context of all listeners, I'm like a delegator extraordinaire. Like, I don't want to do anything in my yard. I don't want to build anything on my house. I don't want to paint walls, build furniture. Like, we're ordering a bunch of furniture for the office this week. I'm very excited that Olivia is going to build all of it and that I'm not going to help at all. I'm very excited about that. But like, on a fundamental level, my wife is the opposite person. Like, she's the I can do that, I can do anything type of person. And I love that about her. But I'll be honest, there's occasionally things that she builds or creates where I'm like, cool, that is not as good as it could be. And now we're going to have a little bit of a disagreement about the quality of the thing versus like the money saved or enjoyment had by building it. Like for example, she's been trying to build a floating shelf for like 2 years now, and it's still not built. And I'm like, look, we literally have like 4 pieces of wood just like sticking out of a wall in our house, waiting for that shelf to get built, and it's not built. And I'm really tired of it. It's like, look, at some point, either just pay somebody to put in a floating shelf or get it done. But like this half shelf thing is just absurd. You got to just get this done. We have a set of steps on the side of our house, and like they are safe to walk on, but I don't love them. They're just like not as pretty as they could be. So like there's things like that as well, where it's like, look, just because you literally can do it, maybe it doesn't mean that you should do it. In the same way that just because I can use my wife's interest in crafting things as an example, maybe it doesn't mean that I should have used my wife's interest in crafting things as an example.
Sure, that begs a big question. Does she listen to the podcast?
I'm going to hope no, but I have a sneaking suspicion somebody's going to rat me out. So whoever you are, thanks.
All right, I'll save you from talking about that anymore. We're on to my third and final question here, which is somewhat similar. But when we're thinking about investing, but more in the short term now, let's say someone wants to buy a house or something, a large purchase in like 2 to 5 years. What is the best place for them to put their money? Should they be invested in the markets and trying to get these huge returns and things like that?
No. Simply put, the golden rule of investing is never invest something you can't afford to lose. And when you've got short-term goals, that is probably a thing that's important to you. Now, there's maybe a little bit of difference. Like maybe you're trying to buy a house versus you want to like pay cash for a car in a couple of years. And so you think to yourself, like, okay, saving up a down payment versus buying this car. The down payment's probably a little bit more concrete than the car is, because the car, unless your car is going to like explode or something, you can keep driving your current car, or you can get a slightly cheaper car, whatever the case is. But like real estate's got some pretty hard hurdles in it. Like you really do have to build up enough savings to afford a level of down payment reflective of your current market environment. So when you're trying to save for short-term things, you're much better off with high-yield savings, money markets. If you've got a really fixed timeline, doing a CD at a high-yield institution and knowing that you're not going to break it because you're definitely not going to do this for like a year or two or something like that. I think those are much better approaches. I think the longer the timeline, the more risk you can introduce. But when we're talking about like 5 years or less, we probably shouldn't be investing with any degree of substantial risk.
Sure. Is it ever worth it in those situations to do a little bit of rate chopping? Like one high yield savings account will go up 0.25%, so you move all your money over there and try to make a little bit that way?
I think you can spend a lot of time chasing pennies. At some point, I think you just want to pick a high yield institution and then just keep an eye on how well it's doing relative to others. But if it's lagging by like 10% on a relative basis. So like, one institution's offering 4% and you're at like 3.7 or something. Like, I don't think it's worth chasing over to that other institution just because the time, energy, and effort factor. And particularly if it's not a guaranteed rate, there's that. There's also a strategy in like bond investing where you can do what's called duration matching, just saying like, okay, and it's called immunizing your portfolio. You're going to pick something like US Treasuries that have the exact duration that you want for your investments. Like, you're going to need your money in 4 years. So you buy treasuries with a 4-year duration. And then it doesn't actually matter if the market goes up or down or interest rates change, whatever, because your outcome is essentially mathematically defined at that point, barring the failure of the United States government, in which case you're probably not buying that house anyway. So there's just situations like that where you can take on like a little bit of risk or you could shop around a little bit. I think it makes sense to do a lot of homework on the front end, but like once you got your strategy, try to stick to it. You can just spend a lot of time chasing pennies.
Sure. So short term investing is significantly easier. It's a very simple answer. There's nothing else there.
Well, and it's not so much that there's nothing else there. It's just that like risk is not worth taking at that point. Because like think about it this way. Let's say you're trying to fund your wedding. And then it's going to be in 2 years. So you put all your savings into the stock market, and 2 years from now the market's down. You're going to push your wedding? You're going to tell your fiance, hey, sorry, but the market didn't go so well, my bad. Like there's just this element of sort of embarrassment and shame, and I don't like to put emotional terms on it, but like just thinking pragmatically here, right? Like how badly you're going to mess up your life goal because you got a little greedy. And don't get me wrong, like if you put your money in at the right downtime and the market just blows up by 20% in the following 6 months or something, you might outdo several years of performance of CDs or money markets or savings. But just as easily the market could go down. So that I think that's more the factor here is when you've got a short-term goal, take risk off the table as much as you can.
Sure. No need to roll the dice.
More or less. Like it could work out, but it also couldn't. And if the couldn't is unbearable, don't.
All right. That answers my question.
All right. Well, that's easy. You know what follows now.
What have I learned since our last podcast?
Perfect phrasing right there. Tell us, what have you learned?
Trying to get ahead of things is usually the way to go. I'm going to circle back to what we talked about at the beginning of the podcast, which is the markets, everything going on, people are stressed, right? I have found that communicating with people about it and through it and during it is certainly a lot easier and better for everyone's mental health than waiting for a panicked phone call or email and then trying to clean up the mess of someone who's maybe been spiraling for a few days and they're really worried about something they have seen or don't understand or heard about. It's better to just call everyone, talk to them, see how they're doing. I think it's very helpful.
I think it's part of it. I think also people occasionally have a bit of a cake and eat it too attitude around investing. There's a risk management software called, I think it's Nitrogen now. It used to be called Riskalyze. Lots of problems with that software, in my opinion, and its methodology, but it does have one thing down really well, which is it uses like a speed limit sign to denote risk reward. And the idea here is like, oh, if you're like a 90, you're taking on a lot of risk, but you're also probably targeting a lot of reward. And I think it's the same thing in portfolios. I think that metaphor actually holds up pretty well, which is a lot of people really want to put their foot, down and be on the gas, speeding towards their destination, and then get upset when the possibility that they could get a ticket shows up, or that might get them into an accident shows up. And I think that's sort of the thing is, when you are having good times, the more aggressive you are, the better it's going to treat you. But when the bad times come, unfortunately, you don't get to take your foot off the gas before that accident or that bump in the road happens. It happens, and then you have to deal with the consequences.
Sure. It's a tough conversation to have, though. Not everyone wants to hear that.
Back to the spreadsheets thing. I'm going to do spreadsheets. You're going to talk to the people. It's going to be great.
That's fine. I like talking, even if it's not always the most fun.
Perfect. Deal. The Science of Wealth is produced by My Wealth Planners, a registered investment advisor in Colorado. The theme song is This Is Your Time by Dan Phillips. The podcast is intended for educational purposes only and is not investment advice or any other form of advice. Not all material discussed on the podcast is appropriate for every individual in every circumstance, so you should consult with a certified financial planner, tax professional, or legal professional as appropriate before attempting to apply any of the subjects, strategies, or tactics discussed on the podcast.